Setting sail on the open seas of investing can be both thrilling and daunting. On one hand, the promise of financial growth and the allure of future wealth calls us to venture out. On the other, the potential risks of market volatility and the unknown often leave us hesitant to take the plunge. Whether you're new to investing or looking to deepen your understanding, the key to mastering this financial journey lies in understanding the fundamental relationship between risk and return. Today, we'll explore the basics of investment for savers, what you need to know to start navigating the seas of financial growth confidently and successfully. By the end of this video, you'll be equipped to set sail on your investment journey, ready to face the risks and reap the rewards that lie ahead. Let's dive in. Venturing into the world of investments is like setting sail on uncharted waters. The promise of new opportunities and financial growth is enticing, but with it comes the challenge of navigating through market volatility and economic changes. At the core of this financial voyage is a simple but critical concept: the relationship between risk and return. Understanding how these two forces interact is essential to making informed investment decisions that align with your goals and risk tolerance. So, what exactly is risk? In the realm of finance, risk refers to the uncertainty of outcomes. When you invest, there's always the possibility that the actual return will be different from the expected return. This could mean earning less than you hoped for, or even losing part or all of your investment. On the other hand, return is the reward for taking on that risk, the gain or loss you experience over time. The general rule is that the higher the risk, the greater the potential reward. But with greater potential rewards come higher stakes, and managing this balance is at the heart of smart investing. Let's start with some of the safer, more conservative investment options. Savings accounts and certificates of deposit, CDs, are considered low-risk investments. These options provide capital protection and guarantee a modest return in the form of interest. However, the return is usually minimal, often just enough to keep up with inflation. It's like staying near the shore in a boat. There's little risk of anything going wrong, but your chances of discovering new opportunities are limited. Bonds, meanwhile, offer a middle ground between low-risk and higher-risk investments. When you buy a bond, you're lending money to a corporation or government in exchange for periodic interest payments and the return of your principal at maturity. The risk level depends on the issuer's creditworthiness. Bonds issued by stable governments are considered very safe, while corporate bonds carry more risk. Bonds offer higher returns than savings accounts and CDs, but there's still some risk involved. It's like sailing a bit further from shore. There's more opportunity, but also more to manage, like the risk of the issuer defaulting on the bond. Next, we come to stocks, where the waves of risk and return grow much higher. Stocks represent ownership in a company, and when you invest in stocks, you're buying a piece of that company. The value of stocks can fluctuate dramatically based on company performance, market conditions, and broader economic factors. Stocks offer the potential for significant returns, particularly over the long term, but they also come with the risk of substantial losses. Investing in stocks is akin to sailing into deep waters. There are high rewards to be found, but the journey can be unpredictable and volatile. For those who want to mitigate some of the risks associated with individual stocks, exchange-traded funds, ETFs, and mutual funds provide a way to diversify your investments. These funds pool together a variety of assets, stocks, bonds, and sometimes other types of securities, allowing you to spread your investment across a wide portfolio. This diversification helps to reduce risk because the poor performance of one investment can be offset by the strong performance of others in the fund. Think of it as sailing with a fleet. If one ship encounters rough seas, the others can help keep your overall journey on course. Real estate is another investment option that combines risk and return in unique ways. Investing in property, whether directly or through real estate investment trusts, REITs, offers the potential for high returns, especially as property values appreciate over time. However, real estate investments also come with risks, such as market downturns, rising interest rates, and the challenges of property management. It's like setting a course for distant lands. The journey requires significant capital and commitment, but it offers the potential for substantial rewards. No matter which type of investment you choose, understanding the relationship between risk and return is key. Each investment option comes with its own set of risks, and it's important to align your choices with your financial goals, time horizon, and risk tolerance. This process allows you to strike the right balance between playing it safe and seeking growth, helping you navigate the seas of investing with confidence. For many beginner investors, stocks, bonds, and mutual funds are the primary building blocks of their portfolios. Let's break these down further. When you invest in stocks, you're buying shares of a company and becoming a part owner of that business. Stocks have the potential for high returns, especially if the company grows or performs well over time. But with this potential for high rewards comes high risk. Stock prices can be highly volatile, influenced by factors such as market conditions, economic trends, and company-specific news. This volatility can lead to substantial gains, but also significant losses. The key to stock investing is diversification, spreading your investments across different industries and sectors to reduce risk. Bonds, on the other hand, are loans you make to a corporation or government in exchange for regular interest payments and the return of your principal when the bond matures. Bonds are generally less risky than stocks because they provide steady, predictable income. However, the returns on bonds are typically lower than those on stocks, and there's still the risk that the issuer could default, especially with lower-rated bonds. Mutual funds are a popular choice for investors looking to diversify their portfolios. These funds pool money from multiple investors to buy a diversified mix of stocks, bonds, and other assets. The advantage of mutual funds is that they provide broad exposure to various investments, even for investors with limited capital. A professional manager oversees the fund's portfolio, making decisions on which assets to buy and sell. However, mutual funds often come with management fees, which can eat into your overall returns. Another important principle to grasp is building a diversified portfolio. Just as you wouldn't sail to only one destination, a diversified portfolio spreads your investments across various asset classes, stocks, bonds, real estate, and more. The goal is to reduce risk by ensuring that if one investment performs poorly, others can make up for the loss. Diversification is the foundation of sound investing, allowing you to weather the ups and downs of the market with greater resilience. As you begin your investment journey, it's important to establish a strategy that aligns with your financial goals, time horizon, and risk tolerance. Younger investors may be able to take on more risk by investing heavily in stocks, while those nearing retirement might prioritize safer investments like bonds. The key is to create a balanced portfolio that evolves with your needs and circumstances over time. It's also worth noting the role of robo-advisors and financial planners in helping you manage your investments. Robo-advisors are automated platforms that use algorithms to create and manage your portfolio based on your risk tolerance and goals. They offer a hands-off approach to investing, often at lower fees than traditional financial advisors. For those with more complex financial situations or who prefer a more personalized touch, human financial planners can provide tailored advice and guidance. Both options have their advantages, and the right choice depends on your individual needs and preferences. Finally, once you've started investing, it's important to monitor and adjust your portfolio over time. Market conditions and personal circumstances can change, and your investment strategy should evolve with them. Regularly reviewing your portfolio ensures that it stays aligned with your goals and risk tolerance. Rebalancing your portfolio, adjusting the mix of assets to maintain your desired allocation, can help you manage risk and stay on track toward your financial objectives. Investing is a journey, one that requires a balance of courage, knowledge, and patience. Whether you're dipping your toes into savings accounts and bonds or navigating the high seas of stocks and mutual funds, understanding the basics of risk and return is critical to making informed decisions. By diversifying your investments, building a portfolio that aligns with your financial goals, and staying the course, you can set sail confidently on the path to financial growth. Remember, investing isn't about overnight success. It's about steady, informed progress toward your financial future. So start your journey today, keep learning, and trust that with time and perseverance, you'll reach your financial goals. Safe sailing.